Hello. Here at Acully, we're often asked about the tax options available to a foreign owner of a U.S. LLC. Depending on your goals, there are two possible options. Let's go through them together. While there are many others, we'll talk about the two main formations. The first option is being categorized as a disregarded entity. The second option is being categorized as a C Corporation. As a disregarded entity, the LLC itself does not pay taxes. Instead, the owner reports the income directly on their personal tax return. Additionally, foreign owners are to file Form 5472 to report transactions between the U.S. and a foreign owner. Another consideration under a disregarded entity is the necessity of filing a personal income tax return using Form 1040-NR. The income from the business is reported on Schedule C, Profit or Loss from Sole Proprietorship. To file Form 1040-NR, you must have a Social Security number or individual taxpayer identification number. As a disregarded entity, U.S.-sourced income is treated differently than non-U.S. sourced. Alternatively, a foreign-owned U.S. business can be taxed as a C Corporation. Under this classification, the entity itself is the taxpayer. This also applies if there's more than one owner. Each year, the business is required to file Form 1120 and Form 5472 to comply. With this classification, there isn't a distinction between U.S.-sourced and non-U.S.-sourced income. The business is required to pay a 21% federal corporate income tax on all income. As a foreign sole owner of a U.S. LLC, it's important to consider the pros and cons of each option. There's no right answer since everyone's situations are different. Here at Acully, we will help you make an informed decision for your U.S. investment.